Hello everyone. I will discuss chapter 2 in this lecture. This chapter is about security markets and transactions. So these are the concepts that we will cover in this chapter. So we start with a brief overview of security markets. Security markets means a platform where buyers and sellers come together and they do financial transactions to buy and sell securities. What are the different types of security markets? So one is money market. Here, short-term debt securities are traded. Then we have capital markets where long-term securities, both debt and equity, are traded. The Securities and Exchange Commission is a federal body which regulates the security markets. The capital markets deal with long-term securities, and one type of capital market is primary market. Here, new securities are issued and sold to investors. One prominent activity in the primary market is initial public offering. That is the first sale of a company share to the public investors. So these are information about the number of initial public offerings in the US in different years. So what are the different types of activities in the primary market? One is initial public offering, that is shares are sold for the first time to public investors. Then there are rights offering. So these are shares offered to existing shareholders on a pro rata basis. And then we have private placement. So these are securities sold directly to a select group of investors. So we look at the IPO process, that is the process of initial public offering. So there is underwriting where the investment banks are involved and they help to create awareness about the stock and also facilitate the sale of the stock. Prospectus is an information document which is filed with the market regulator, which gives details about the company as well as its shares. Then there is a quiet period. After the prospectus is filed with the market regulator, there is some time during which the company has restrictions on what information it can share about the company and its shares. The red herring prospectus is a preliminary prospectus available before approval from the market regulator. So it is available for disseminating information prior to approval from the market regulator or during the period when approval is pending. Roadshow means a series of presentations done to inform investors about the company and its shares. So this is the typical cover of a red herring prospectus. Two metrics related to IPO. One is IPO underpricing. It's the percentage difference in the market price at which the shares start to trade and the official offer price, and gross proceeds at the offer price into the total number of shares sold during IPO. So what is the role of the investment banks in the IPO process? The investment bank assists company to raise capital. In this case, they assist the company to issue new securities as well as they help them in filing the prospectus with the market regulator. So they are involved in underwriting. That is, they purchase the security from the company and they undertake the risk to sell it to the public. So if it is a large initial public offering, there will be multiple investment banks involved. So they form the underwriting syndicate. Then there is the selling group. So these are brokerage firms who help the underwriting syndicate to sell the shares to the public. So generally compensation is in the form of discount on the sale price. So the company will sell to the underwriting syndicate at a certain price. There will be a markup and the underwriting syndicate will sell it at a higher price. The selling group will then add a markup and they will sell at a higher price to the public. So each intermediary earns some earns some fees by the markup on the sale price. So issuing firm, syndicate, selling group, and then finally the public investors. There is another kind of public offering, which is called a direct listing. In this case, the company does not issue any new shares. They transfer existing shares to the stock exchange. The stock exchange then studies the demand for the shares and accordingly sets a price to start public trading. The benefits is the company does not have to pay fees to the investment bank. And it also allows some of the investors to liquidate their holdings by listing the shares directly on the exchange. Disadvantage is there is no roadshow to create awareness about the listing. There is also uncertainty about the initial price, and also no new capital is raised, because this is listing of existing shares and transfer of ownership to public investors. Now we look at secondary markets. So secondary markets are involved after the stocks have been issued or after the securities have been issued and they are now available for public trading. So the secondary market provides a mechanism for continuous price determination. It also provides liquidity by allowing continuous buy and sell of the securities. So there are two types of secondary markets. First are the National Security Exchange. They are platform to bring together buyers and sellers, and they have securities listed on with them. Over-the-counter market involves trading in smaller unlisted securities, which may not want to or which may not be in a position to comply with the regulations of a security exchange. So who are the intermediaries? The brokers and dealers, based on which we can figure out what is the nature of the secondary market. So one is broker market. So here the buy and sell trades are executed by the buyer and seller. The broker acts as a facilitator to allow the trade to happen between the buyer and seller. The dealer market is slightly different. In this case, the dealer is like a market maker and sits in between the buyer and seller. So the dealer will buy from the seller and then they will sell to the buyer. So in this case, we have ask price and bid price, which are important metrics. Bid price is the highest price at which the dealer will buy from the seller. Ask price is the lowest price at which the dealer will sell to the buyer. So bid ask spread is an important characteristic of a dealer market. So the prominent example of broker market is the New York Stock Exchange, which is the largest stock exchange in the world. And it has some minimum listing requirements. So the minimum stock price should be 400 round lot of shareholders. One round lot denotes a certain number of shareholders. So 400 such round lots, 1.1 million publicly held shares and $40 million in market value. There are also regional stock exchange. They also follow the similar system and processes as the New York Stock Exchange. Then we have options exchange. So options, if you remember, is a security which derives its value from an underlying asset. The buyer of option has the discretion to buy or sell the underlying asset at a certain price in future. Similarly, we have futures exchange where trading of futures happen. Futures, if you remember, is an obligation between the buyer and seller to exchange the underlying asset at a fixed price at a future date. So the dominant exchange for options is the Chicago Board Options Exchange, and the dominant exchange for futures is the CME Group. So now we look at dealer markets. So dealer markets consists of market makers or dealers who are connected via electronic network, and they help create the trading mechanism. They buy from the seller and sell to the buyer. So bid price and ask price are important metrics here. And the most prominent dealer market is NASDAQ. The other kind of dealer market is the OTC market. So one type of OTC market is the OTC bulletin book. So here companies have to file audited financial statements and also comply with the federal securities regulation. Companies which are listed on the OTC market group, they are not required to file information with the market regulator. So OTC Pink is for small risky companies. OTC QB is for companies who must provide information to SEC, bank, or insurance. And OTC QX is for companies who will provide audited financial statements and any other relevant information. Then we look at electronic communications network. So these are computer-based trading systems. They try to match buying and selling orders. So they are effective for high volume and actively traded securities. And there is also high frequency trading. So these are based on computer algorithms to find trading opportunities, and they are becoming very popular. They account for almost 50% of equity trading in the United States and Europe. We can classify security markets based on the overall macroeconomic conditions. So one is bull market. The economy is growing. The security markets witness rising prices, and investors are also optimistic about generating returns. The other is bear market, where the economy is slowing down, the prices of securities are falling, and investors are not so hopeful about generating returns. So now we look at an emerging trend in securities market, that is globalization. Investors want to invest in foreign markets also. One reason is diversification. So they want to increase the different types of assets within their portfolio. So that may help to reduce risk, increase returns. There are other important considerations for increasing popularity of foreign security markets. First is the growing importance of security markets outside the US, both in developed countries as well as in emerging countries. So they provide an opportunity for investment. Also, there is a lot of collaboration between security exchanges across the world. There is also merger happening between different security exchanges. So that creates an enabling mechanism for investors in one country to do trades in a security exchange of another country. Not only for shares, but also for bonds. So bond markets are also going global, where foreign investors are investing in different bond markets. The second reason is performance. So some of the foreign markets have provided higher returns than the US securities market. So it provides an opportunity for higher return generation. Of course, there is also a caveat that many foreign security markets are riskier than the US markets. So what are the different ways to invest in foreign securities? One is an indirect way. I buy shares in a US company which is doing business in foreign markets. Then there is a direct way to invest. So I buy securities on a foreign exchange, foreign stock exchange. I can also buy securities of foreign companies which are listed on US stock exchange. And then I can buy in American depository receipts. So these are US dollar denominated receipts for shares of foreign companies which are held in banks in the country of origin of the foreign company. So that this ADRs help US investors to trade, that is to buy and sell securities of foreign companies. But there are some risks involved with investments in foreign markets. So there are usual investment risks which are present in the domestic markets. Apart from that, there is a political risk. The political environment in the foreign market may not be favorable, which may have a negative impact on the returns generated. Then the currency exchange may not be favorable, and that may also have a negative impact on the returns generated. So with that, I'll end the lecture here and I'll continue with the rest of chapter 2 in the next lecture. Thank you.